Well, our next guest recently has pared his holdings in banks, saying the margin of safety in their shares is shrinking. So what does he make of the banks repaying their TARP funds? He's Whitney Tilsonm, founder and managing partner of hedge fund TZ Partners, who correctly predicted the financial crisis, among other things in housing, Whitney, which, of course, we'll talk about a bit later. But first of all, just listening to what Doug was just saying about repaying TARP funds. I mean, essentially, if they are able to, if these banks are able to, should they be allowed to pay these funds?
Right. I would say no in general. Every bank's a little bit different, but the gentleman, Doug, who was speaking a moment ago, I think correctly pointed out the banks aren't out of the woods. Hideous losses coming in commercial real estate. As our book notes, hideous losses coming still in the mortgage area, in the housing sector. These are highly leveraged financial institutions to this day, even though they've raised capital, in the midst of the worst economic downturn, the Great Depression. So why is it a good idea to allow them to remove capital from their balance sheets when nobody can be sure whether they're out of the woods yet? It would strike me that prudence would indicate wait till the end of this year before allowing them to repay that money.
Well, what would change by the end of this year?
Well, we'd have a much better idea of whether the recent signs of stabilization are a head fake, which is what we think is likely the case, or whether it's for real. We'd have another 6 or 8 months of data, and it would just be, it would reduce the odds of a really bad outcome, which, as that gentleman pointed out, the worst case scenario would be to have them repay the money, then have big losses come in later this year, and then have to go back to the government for yet another bailout.
Right. In fact, that is certainly what he said, but at the same time, what I was kind of gauging or getting from his comments was that even if we do see big losses coming ahead for banks, it may not be enough, though, to jeopardize the entire banking system. You disagree with that?
I think it is likely that these institutions, the strongest 10, are going to be okay. To the extent that losses come in, that they're earning enough money that they can outrun those losses. I think that's likely. But even if there's a 10% chance that they can't outrun it and that they need to raise more capital, and the capital markets are closed, and they can close. Right now, capital markets for these institutions, they've all been able to raise money privately, and that's an important factor.
Yeah.
But literally in a matter of days, that window can slam shut. These markets can move so violently. So at precisely the time, of course, that they would need to raise the money, I guarantee you the capital markets will not be open for them to raise that money.
At that point, at that critical point.
And so then they're going back to the government, and, all heck is breaking loose.
Right. Whitney, you've been a bank investor for quite some time. You've shorted also banks as well.
Sure.
In your opinion, though, I mean, the capital that we've seen given to these banks in the last 8 months or so, has it done any good?
Yeah, very much so. I mean, look, the capital was given to them at a time when many of these banks literally would have filed for bankruptcy. There was, to some extent, the capital that was given to them was building market confidence to enable them to weather what was really an investor panic. So it was absolutely the right thing to do. It was critical to their survival. And we definitely want the government out of this business. We want that money paid back, but we only want it back when we're 99% sure that they won't need that money, not 80 to 90% sure.
So a bit more margin of safety, less of a head fake. Okay, Whitney, we're going to talk a bit about another head fake, which is housing, and that would be a bit later in the program, so just stick around there, Whitney. And we are back with Whitney Tilsonm, founder and managing partner of TZ Partners, and we're now focusing on housing. And the reason is that, Whitney, in your reports, you have warned that, in fact, we're about a year away from seeing a bottom in the housing recovery. And, in fact, the people talking right now about a recovery or stabilization, you say it's the mother of all head fakes. What do you mean by that?
Yeah, basically, I think people are being fooled by some indications that are leading people to believe we may be at a bottom in housing prices. First and foremost, seasonally, the spring, April, May, June is strong for home prices. And then secondly, when Obama was elected, there was a foreclosure moratorium by Fannie and Freddie, and most of the big banks and servicers followed. So there's a real drop-off in the number of homes coming through that foreclosure pipeline. So today, that's resulted in an artificially low, though still historically very high inventory level for homes, and that's helping stabilize home prices. But that foreclosure moratorium ended a couple months ago, and we're seeing the early data. You can see the pipeline building. It's going to lead to a lot more homes being hitting the inventory later this year, and that's going to really pressure home prices. So we figure, roughly speaking, we've got at least another year of home price declines.
Can you give us a sense of, the inventory that we see right now? I mean, how much higher do you expect that to go then towards the end of the year, and how much lower do you expect housing prices to go then?
Right. Well, inventory historically, long-term, a healthy, normal level might be 5 or 6 months. Today, we're at about 10 months according to official statistics, but that's missing all of the shadow inventory. Banks that have already foreclosed on homes but haven't yet listed them, but also that foreclosure pipeline, the homes that aren't yet foreclosed on, but they've issued the notice of default. The foreclosure is coming. That's certain. So you look at that data, and we're seeing, my best guess is there's somewhere between 16 and 20 months of inventory, not 10 months. And
really?
And it's going to take us time to work through that.
So then even given that scenario, it almost seems like it may be too optimistic to think that a housing bottom could happen by next year. What do you...
Yeah, well, the bottom, when we reach the bottom, I don't know exactly when that will be. That will be a function of three things. What happens to the economy, particularly unemployment. Number two, what happens to interest rates. And thirdly, the biggest wild card is what happens to homeowners? How do they behave when they're underwater on their mortgages? Because right now, about 25% of all mortgages, people are underwater. There's never been any historical precedent. There have never been a large number of Americans underwater because home prices have been so stable. So will they walk or will they keep paying those mortgages? So, you know, even though it may be economically rational for them to walk, will they stay and keep paying if they're able to? So that makes it very difficult to predict when we will bottom. But I'm much more certain that when we do bottom, there isn't going to be any quick rebound. So we could be at bottom for a number of years.
Well, what does that mean then for somebody like me, let's say, who's in the market to buy a home? Does that mean that the house, your home, is a dead asset class in terms of an investment, or what?
Well, I would say, one, it really depends on where you are. There are many markets that are much closer to a bottom, and there you'd see home sales really picking up. In most of the country, sales have dropped dramatically, and whereas, for example, in California, home sales are up 65% year over year. That market is sort of reaching a clearing price. Home prices in California are already below trend line. Why? Because home prices are down 57% from the peak just over 2 years ago. So whereas in a lot of other markets, the market's sort of clogged up. The sellers don't want to sell at the prices the buyers are willing to pay. So the answer to that question really depends on where you are. But people, I don't think, should be buying housing for investing purposes today. I think it's much too early for that.
Not quite yet. Okay.
Yeah.
All right, Whitney, great to talk with you. Always nice to see you, especially not in Omaha this time, but here back in New York. Whitney Tilsonm of TZ Partners.